Investors are getting mixed signals right now. Strong markets one day, scary headlines the next, leaving many people asking, how do I stay invested without taking on more risk than I realize? Jake Schurmeier is portfolio manager, head of fixed income, currencies, and commodities, multi-asset solutions team at Harbor Capital Advisors. He joins us now. Jake, great to have you back. Thanks so much for being here.
Thanks for welcoming me back, Caroline.
So Jake, when you zoom out, what kind of market are investors actually dealing with this year? Is this still a momentum market? Seems to be today, right? Or is it something, I guess, more complicated than that?
Yeah, I think the one sentence thesis is the market's broadening out. So you're going to get a cyclical boost in the US, so long as we don't kind of stumble over it, whether that's Greenland, tariffs, all of these other kind of fireworks, if you will. If we can avoid those pitfalls, you're going to get a fiscal boost in the first half from last year's tax plan. That's going to provide, households the ability to spend, invest, and that's going to continue to see profit growth. And what you're seeing now, I think, is, broadening into, sectors beyond tech, materials, banks, small cap, things like that. And we think, as the AI trade continues to mature, you're going to have to see broadening of the technology diffusing throughout the real economy, seeing more productivity growth, seeing kind of better operating margins in smaller and kind of the left behind sectors. And so we think there is going to be some legs to this broadening out trade so that, the top line index can continue to do well, but you're going to see kind of a rotation from, that kind of single factor bet, large cap tech into these kind of smaller, more cyclical assets.
Okay, so I want to talk about how to diversify in a broadening out market and also get your take on tech. But first, for everyday investors, what should matter most to them right now, given some of the headwinds that you mentioned at the top? Is it managing downside risk? Is it maximizing upside? Is it just simply being better diversified? What should the number one priority be?
I think the first thing you want to know is what are your ultimate macro bets that you have in the portfolio? We think one of those bets should be long, equities. We like the US, but we also like, diversifying abroad. So EM, we think looks particularly attractive. Some of Europe, it's been beaten down during the Greenland headlines, but, so you want to be, overweight equities. You want to have global exposure. That's kind of your first macro bet you want in there. We think the second one is you want to be kind of shorter interest rates, shorter duration, because we think, fiscal spending is going to get more fiscal spending in the US as we approach the midterms. We also have kind of Japan, experimenting with potentially more pro-cyclical behavior. And we think both those things are going to weigh on global interest rates. So you want to be kind of shorter duration. That's one of the bets. But, if you kind of take those two things as a starting point, your long equities and your short interest rates, what's going to hedge the rest of your portfolio? And that's where we think commodities really play a strong role. We've obviously seen a pretty remarkable run in precious metals, gold, silver. We continue to like gold here as a way to diversify. Hey, if we're wrong, the economy slows, if the US just can't help themselves and kind of all these political issues, then we do think precious metals can provide that diversification that you miss if you're underweight kind of core fixed income.
Okay, so a lot to break down there. I should note you were last on with us, I believe, in September, and you didn't think it was too late for gold. You still don't think it's too late to get in gold right now?
I don't. And thanks for remembering the wins there. It's usually you're talking about the losses with investors. So it's fortunate to hear that. Yeah, we think there's, I don't think that we're going to see the breathtaking gains that we saw in 2025 by any means, but we do still think it, has clear diversifying properties. Just the last week it has shown you that headlines around Greenland, headlines around people diversifying out of the dollar. What does quite well? Gold, especially at the expense of silver, where you saw a little bit of that kind of divergence between those two assets start to compress a bit. So we still continue to like gold for kind of the secular upturn in geopolitical risk and kind of, the policy discussion going on globally. You saw Mark Carney at the, WF forum in Davos just earlier this week talking about how we are kind of entering this new world. And we think gold continues to work well for that new world.
Okay. It's interesting when we think about diversification. I think a lot of investors might think they're diversified, but then when you look under their hood, they might be heavily dependent on a handful of US tech stocks and not even realize it. So how real is concentration risk right now? And I think then the other question is what happens if those big tech leaders stop leading?
Yeah, I mean, it's definitely a large risk. It's something like 40, 50% of the S&P 500. And for us, who believe in active management, it's also kind of a headwind for, stock picking. And we think that's going to turn around. It's not to say the kind of large cap tech are going to, derate massively or, that we have some negative kind of long-term view on, the Mag 7 by any means. We just think, there's going to be some frictions as AI is adopted. There's going to be some winners and losers. And for AI to really work kind of in the long run and kind of generate the productivity gains that we hope to see, you're going to have to see companies other than the largest cap tech companies benefiting. And so we're starting to see that trade. We're 22 days into the year, but we think that has more legs to run here as a lot of these kind of smaller cap, more cyclical assets can re-rate here.
How do you stay invested and not miss out on any potential gains, though, in that space without being overexposed?
That's the hard question. So I think there's kind of two ways we're approaching it. We think kind of maybe the second order parts of the semiconductor space still look fairly attractive. Just thinking about companies that are closer to the edge, memory, things like that. And so you can still get some of that AI beta there, but you're kind of less exposed to the core kind of GPU trade of NVIDIA, AMD, that was 2023, 2024. On the other side of it, we do think, if you want to kind of if you're concerned about the AI trade and you want to hedge that, software is a really natural place to do that. Kind of the thesis for the D-rating we see in software names, your Salesforce, your Adobe's, is hey, you can stand up code, you can stand up working prototypes really easily today with AI, and that's objectively true. And so, people are concerned about the long-term moat of these kind of, stores of record, these kind of long-term legacy enterprise software names. So if you're concerned about AI or you just want to hedge some of that risk, we think software is actually a pretty natural place where you can still get some kind of secular growth and you're hedging the risk that AI kind of slows down. That's something we have in our portfolio, our multi-asset explorer, MAPP. Software is one way we're kind of hedging the risk that AI slows down more aggressively than we expect.
How should investors be thinking about the Mag 7 specifically in their portfolios?
Yeah, I mean, I think there's going to be more idiosyncratic performance there. You saw Google really kind of storm ahead over the second half of last year as, the trade going into 2025 was, OpenAI, Anthropic, all these companies would, really kind of eat Google's lunch in search and kind of its core businesses. Google's kind of transformed that narrative and saying, hey, we actually have the distribution and it's done quite well. Meta's a name that's kind of, relatively struggled compared to the rest of the Mag 7. I don't think we have as clear of a view there in either direction. But we do like NVIDIA actually at this point. It has derated a lot. It is starting to make more aggressive moves with the acquisition of, Grok's intellectual property towards the close of the year. It's thinking more about the inference side, and it's really aggressively pushing into kind of human, robotics, and so kind of the real world AI, if you will. And so I think it's a mixed bag. I don't think you can paint the Mag 7 with a broad brush like you could over the last few years, where it's hey, these are all kind of hyperscalers, one factor AI bet. We can buy any of them, and you're going to do quite well. I think you need to kind of have more differentiation among them.
Okay, so you mentioned the Harbor Multi-Asset Explorer ETF MAP. You've said it's designed to participate in different phases of the cycle. So I guess two-part question to wrap things up. What phase of the market cycle do you think we're in right now? And how does MAP adjust as conditions change? Because they seem to be changing every day.
Yeah, that's right. So right now we're in late cycle. So, in a time when valuations are pretty high, credit spreads are very tight. But generally you want to keep the carry going. You want to keep, dancing as the music plays, if you will. How MAP would evolve is we get signals, whether that's, internals from the market, the economy, whatever it may be, that tells us, hey, we're shifting, whether that's kind of a more recessionary market or we're kind of reshifting back into early cycle if we really see the fiscal stimulus start to boost the economy. And that's how we'd evolve from here. But right now we're kind of stuck in this late cycle. Valuations are, at a premium, but you need to kind of continue to embrace carry and know that the most likely outcome is the market to continue to drift higher here. And so you want to be kind of long equities, shorter interest rates, and kind of thinking about your diversification portfolio through the commodities side.
Okay, so continue dancing while the music's playing. The market's drifting higher. Are you bullish on 2026?
It's a hard one. I'm neutral, I think. I think we're going to be much closer to kind of median, kind of long-term returns. I don't expect, the fourth or fifth consecutive year double-digit returns for the equity market. I think we're going to be much closer to an average year, if you will, by kind of long historical standards. Of course, an average year over the last 15 years is, double-digit
Sure.
gains, really robust earnings growth. I think we're going to be closer to the long-term average this year.
So mid-single-digit gains for 2026.
Yeah, you're pinning me down, and I'll take it there.
Okay. Jake Schurmeier, Portfolio Manager, Head of Fixed Income, Currencies and Commodities, Multi-Asset Solutions Team at Harbor Capital Advisors. Always great to have you. Thanks so much for breaking it all down for us.
Thanks so much, Caroline. Pleasure to be here.